Hey guys, Dave with Moneyology on Markets here. This is the weekend market review for March 23rd and 24th, 2019. Overall, my views on the market have been fairly mixed over the last couple of weeks. They've seen a lot of positive developments in technology and tech names, Google, Amazon, Apple, Netflix, and so on, Nvidia. And yet, I saw a lot of divergences in the overall markets. I've been posting, if you've followed me on Twitter, StockTwits, a lot of these divergences that have been going on, both on the daily and the weekly, a lot of bearish wedges. And last Thursday and Friday, we've seen a considerable breakdown in these wedges, which I'm going to discuss today. For those of you new to the videos, these are from a weekly standpoint. We try to remove some of the short-term noise in the markets to get a better assessment of the longer-term goings on of the market. Now, I will point out these videos are not the most sexy videos, if you will, and they're not my most popular videos, and that's too bad because these videos are the most important, in my opinion, to understand what's going on in the precious metal space, to understand what might happen in uranium. You really have to have a better sense of what's going on from a macro picture, because what happens here will impact those sectors as well. So anyway, here goes, and we'll start with the 10-year U.S. Treasury, the TNX. So Treasuries here have broken down considerably, and it started here when we had 3 consecutive highs in Treasury yield, but 3 consecutive lows in momentum, and that's very, very important. That's a negative divergence, triple timed divergence, and so breakdown was inevitable. I thought perhaps we would find support here, and we've broken down. And this breakdown is very, very important because it's being led by momentum. So, can we bounce a little bit? Sure, we can bounce, but bottom line is we're going down all the way to 2.1, and frankly, I think that this is basically foreshadowing a recession. It's almost inevitable based on what the treasuries are saying. So that means that there could be considerable downside in the markets. Another 20 to 30% drop is definitely in the cards. And although I can't say for sure when it's going to happen, but certainly within the next 12 months is a very strong possibility. If the recession is deeper than a shallow recession, we can go all the way down to 1.65, possibly 1.5. What does this mean? Well, this means that if you own fixed income, that's going to do very well. If you own precious metals, that's probably going to do really well. If you own anything that has to do with cyclicality, anything that has to do with momentum and trend, that's going to get really hurt during this time. So if you own 100% in those sectors, trim some of those positions possibly, and raise cash, because cash can be king, even though I think the dollar itself will be considerably weaker 6 to 12 months from now than it is today. Now here's the Dow Wilshire 2500 index, which are the 2500 largest names in the world. And you see here, and you'll see this on multiple charts here, is this head and shoulders, constructive head and shoulders, and a negative bearish wedge. Now we broke down. Now momentum is still above this trend line, so I'm not going to go as far as to say that things are really, really dire for the markets until this trend line is broken to the downside, coinciding with that 50 RSI level. However, this is going to set up a multi-week pullback, and let's see what happens thereafter. Can we recapture that strength and break out to new highs, or are we going back to test the lows of December, possibly lower? We shall see. So here's gold. Gold has been a beneficiary of this drop in interest rates, the action of the Federal Reserve, and so you had this nasty dip in the start of 2018, this kind of cup and handle pattern all the way through 2019. We've got this pullback, and now you're getting this handle. So this needs to really break hard towards that 1350 area to really build that momentum. But a weekly close above the 61 level in RSI is very, very important, and I think this is setting up, looking through various PM charts over the weekend, I think the precious metal sector is setting up for a very, very nice second quarter and second half of 2019. High yield junk. So this one's interesting because it has this bearish wedge. It broke down. Now it's kind of retesting it. If you extend this from the downside, momentum is not breaking out even as the sector was breaking out to new highs. That was my first flag for caution. But the thing is with high yield is that it benefits from lower interest rates until those lower interest rates are a sign of a recession, and then this junk credit becomes very vulnerable to economic turbulence. So, it benefited the first time the Fed over here said that they weren't going to raise rates, and then now that there are considerable signs of economic weakness, now it's starting to look shaky. This is a shooting star candle, which is not a positive development, but it's got a lot of momentum here still, so I'm not going to say anything negative on this particular space until it breaks on a weekly close below 35. Housing index, obviously this is very fundamental to the overall economy. Bearish wedge could not break out and build new price highs, and so now we're kind of rolling over. So I want to see what happens here. Similar to junk credit, housing benefits from low interest rates, so in the short run, but then if there's a recession, then it gets hurt. So does it roll over here if there's a recession? Absolutely. If this is a short-term blip on the radar, then it'll break out, and this will be a very good indicator of what you want to look at for the overall health of the economy. Crude oil, another bearish wedge here. Below the 50-week, below the 200-week moving averages. The 50-week has closed below it. That's what they call a death cross. Not always the case, but certainly when you see this considerable evidence of lower lows in momentum, I think that we're going to see low 40s again before we break out higher in crude, whenever that is. Here's the Nasdaq. So Nasdaq, as I pointed out, has been one of the hottest sectors, and it's probably the one index that's least correlated to the overall markets, because tech is not necessarily impacted by the day-to-day ongoing of the economy. But look at this. So far, we're above this trend line, and we haven't broken this bearish wedge. However, if it breaks, I think that a sharp decline is definitely possible, because most of these tech gains have been just on PE expansion and not necessarily because of increased profits or anything like that. Here's the equal weighted index, which means that this one isn't impacted by the large capitalization names. It's every one of these stocks is equally weighted, and so this one is a better barometer of what's going on in the overall Nasdaq. And so right here we never were able to break out of this back test, and now we broke down, not fully yet, but notice this shooting star is very bearish from a technical standpoint. We could not, on this shooting star move, could not make new highs in momentum. So that's a negative double top with negative divergence. If we break below 63, and I think that's going to happen next week, I think there's going to be a multi-week period of decline, and then we'll see what happens thereafter. Russell 2000, this one is a very good barometer for the overall economy, because most of the names here are domestic, U.S. domestically based, and so weakness there suggests probable weakness in the economy. From 2016 all the way through August of 2018, this was the leader, and now we've broken down, and we could not, unlike the S&P and the Nasdaq, we could not make new highs. Even though those two did not make ultimate new highs, they were much stronger than the Russell. And so here we go again with kind of a head and shoulders and negative divergence on momentum. So don't like that pattern if I'm a bull. S&P 500 equal weighted, similar thing. This one is not impacted as much by the bigger names, Google, Apple, Microsoft, and so on. And so this one has been kind of showing weakness over the last couple of weeks. And this one might be foreshadowing that this pullback or potentially larger correction that I've been pointing to. Couple more charts here. Here's the S&P market cap weighted, which is weighted by the larger names in the index, and this too has broken down, shooting star, but for now it's still above that momentum downtrend, so we'll have to see what happens there. Here's another one that's a very good barometer for the overall kind of the underlying grassroots economy, the banking ETF. So this is one of the downsides to Federal Reserve policy going all over the place. And these small banks have positioned themselves for increase in rates and increase in because the overall state of the economy has been great, and yet when the Fed changes its policy, well, these banks can't adjust as quickly, and so these banks are getting hit right now, and they're going to get hit with a double whammy of a weakening economy as well as lower profitability, lower margins. So is this just a retest from the upside? Could be, and this could be a good risk-reward entry. However, if it breaks below that 48 level, notice this here is, whereas the overall economy is, rather, overall sectors have done really well, this is close to the December bottom. So, and this is despite the uptrend we've had over the last quarter. So if this breaks lower, and I think it will, expect to see significant weakness, and this is one of the reasons why I'm probably of the belief that we've got a 70% probability that a recession is coming very soon. Semiconductor Index, another one that's been very, very strong, but again, a shooting star candle is not what you want to see, and a significant pullback is in the cards here. Here's the total stock market index. This includes every single market cap level, both domestically and globally, and it's creating this massive head and shoulders similar to what we saw in 2007. Now, I'm not saying that we're going to see a similar market correction. I have no idea. Nobody else does, but it's definitely ominous to see such a setup right now, just as we're creating close to new highs, yet showing considerable negative divergence on momentum. Now here's another barometer, the transport in average, and here again we could not make new highs. We broke down with the bearish wedge, and we could not make momentum that even hit this negative downtrend. So we're talking railroads, airports, truckers. They're not doing as well as you would expect them to if this economy were healthy, and so I think that's another checkbox in the recession argument. Now here's the U.S. dollar. The U.S. dollar has been fairly strong over the last couple of weeks. It's been holding this 50-week moving average fairly well, but again, look at this negative divergence. Unless we can break higher in kind of this bullish wedge format, I think the dollar eventually goes to 92, and then possibly much lower should we have a recession. I just think that the dollar is showing signs of weakness on multiple time frames, and a lot of folks are positioned for the upside breakout. I just don't think it happens. I disagree, and that would be very bullish for precious metals, for emerging markets, and not for U.S. domestic equities. Finally here, we've got a couple more. We've got the volatility index. That's a bullish wedge. We broke out of it. It's close to breaking above that 50 RSI. If that does, we'll see another couple of moves in the market of negative 2 to 3%. And the media is going to search for narratives why it's happening. It could be this or that. But bottom line is, this is all technically driven. These are computers and algorithms who are reading these very signs that I'm pointing out to you. And obviously theirs are far more complex. But bottom line is, momentum and volatility is breaking to the upside. Okay, you've got the 5,000, Wilshire 5,000, the 5,000 largest names in the world, and here that's breaking down similar to the 2,500 and the various different charts. But again, this one is heavily influenced by some of the larger names, and it has broken to the upside. So let's see if this just retests and goes higher, or breaks down and goes lower. Here's the World XAUUSD Index, and notice it actually did break its downtrend, unlike all the other indices that we've followed here in price. And so it might show weakness, but I think this is the area that you want to be in when the eventual recovery occurs, or if the markets continue in a follow-through after a retest. This is the area that probably is going to act the strongest, and that's in large part due to the weaker dollar that I'm anticipating. Anyway, guys, I hope you've enjoyed this particular video and gained from it. I appreciate your support. If you want to be a part of the premium service that's scheduled to launch around July, shoot me a note at dave@moneyology.com. We've got about 60 slots left, as 40 of you have reserved your spot. I appreciate that, and I encourage you to reach out to me, offer your feedback, and I appreciate all the support. Follow us on Twitter and StockTwits, and subscribe to the videos on YouTube. Have yourself a great week. Take care.